I'm Adam Weinstein. I'm the president of the Roundtable, for those who I haven't had a chance to meet. And we're thrilled to have you here this evening for what's going to be a very intriguing event from just hearing some of the conversation beforehand. So please, we ask people to just turn off notifications on their phones and any devices. And please take a moment to fill out the survey that's on your seat. It helps us. It gives out good information to the group, and it is entirely anonymous. The press is in attendance this evening, and so tonight's discussion is going to be on the record. So now onto the main event. So we're excited to have a great panel of industry experts with us here tonight to discuss Bitcoin and blockchain, what they are and why you should care. So a very interesting topic that people still know little about, and we hope to be enlightened this evening. So our panelists tonight consist of Kirill Gurov, Portfolio Manager and Head of Research at Full Node Capital, Reggie Middleton, Founder and CEO, I'm going to probably butcher this, but Veritasium, all right, and the creator of UltraCoin, Sebastian Vanderziel, Director and Global Thematic Analyst at Cornerstone Capital Group, and Larry Lanzilli, CEO of Transact Block, who also serve as tonight's moderator. So, like all of you eager to hear about the topic, we're going to do about 45 minutes and then turn it over to Q&A so you can all ask your questions. And so, without further ado, I'll turn it over to Larry.
Thank you, Adam. Let's see how close I need to be here. That works. So, thank you everybody for coming. I think the best question to start off with is, what does everybody do? I think everybody introduces themselves, gives just a 30-second overview of your background. Sebastian, you want to kick it off, and we'll come right down the row?
Thanks very much, Larry. So, Sebastian Vanderziel.
Yeah, 2 or 3 inches is perfect. It's got to get a little close.
Sebastian Vanderziel. I'm a director and global thematic analyst at Cornerstone Capital Group. Cornerstone is an investment advisor who believes that integrating environmental, social, and governance factors into the investment process gives us just better investing. So we manage money on behalf of endowments, foundations, high net worth individuals, and as part of the business, we have a deep research team. And so my role is in research. My traditional role has been in markets and trading and other questions, so I've come to this topic a little later, but in a sort of different way, in a way that sort of focuses on some of what are the foundational drivers and for the demand for these type of things. So with that, I'll hand it over.
My name is Reggie Middleton. Used to be an entrepreneur investor. Had my
What's the name of your firm?
Veritasium. Veritas, like Latin truth, EUM. My claim to fame was basically fundamental analysis. I invested my own capital, did my own research. I'm known for calling large macro and fundamental trends: the fall of Bear Stearns, Lehman Brothers, general growth property, the European debt debacle, the mobile technology, etc. Circa 2013, my clients assisted me in catching the Bitcoin bug. But unlike many, instead of looking at coins and remittances, I thought of smart contracts and autonomous markets. So we created a software company that basically enables peer-to-peer capital markets. So you think of conventional capital markets, you have a hub, central bank, money center banks, brokerages, exchanges in a concentric circle. Peer-to-peer capital markets allows Peter to deal directly with Paul, Paul to deal directly with Paulette, without capital, without counterparty risk, exposure to balance sheets, etc.
Hi everyone, my name is Kirill Gurov. I am the co-founder of Full Node Capital. It's a New York-based cryptocurrency hedge fund.
Repeat the name of the company because it's
Sure.
really so hard.
Full Node Capital, New York-based hedge fund focused on the cryptocurrency space. I've been in the industry since early 2013. I published one of the first valuation white papers on how to value digital currency. It was picked up by a bunch of sell-side brokerages for their coverage initiation. Headed finance at an early blockchain company. Worked at a large consultancy focused on fintech. Done a bunch of consulting on my own, focused on helping enterprises and startups understand what is blockchain, what is Bitcoin and cryptocurrency, how does it fit within your value chain, what are the sort of revenue and cost opportunities. So sort of a very broad blockchain background.
And my name is Larry Lanzilli. I'm the co-founder and CEO of Transact Block. My background is certainly entrepreneurial. I've typically gotten involved with companies 3 to 5 years before they've become mainstream. One is home automation and another is flash technology, which I still have an ongoing relationship with. From a blockchain perspective, I approach the industry from an entrepreneurial perspective. I am not a data scientist like I think some of our other panelists are. I do have a degree in computer science, I understand it, but I'm more on the business side. A good example of how fast this industry is moving and my perspective of this industry, Transact Block, just, Monday? So 3 days ago, Friday of last week, is now 100% sold. We are now merged with Acumen. It is an AI, blockchain, machine learning play, and we will be issuing an ICO in March. That was not our primary focus prior, but this merger makes that possible. And that's really why I'm here, from more of that entrepreneurial perspective, right? And to offset the data scientist perspective, which we have some true industry titans up here. So, okay, let's dive in. I think the very first question that we should get to, and we'll get some of the questions we'll do multiple asks to, so that we get different perspectives. But how about we go down to Reggie, and why don't you explain the difference? And I sometimes dislike doing this, but it's so often that when I tell people I'm in blockchain, even family members, I'm in the blockchain industry. Oh, you do Bitcoin? No. So why don't you explain the difference between Bitcoin and blockchain?
Well, maybe if I recast the question, that's like asking, what is the difference between the internet and Facebook?
Correct.
Okay, the blockchain is a consensus-driven, algorithm-driven consensus database. A bunch of big words to say a database where all the participants in the database have to agree before something is considered valid. It is the tapestry that you create a painting on, okay, like the internet. The applications are the actual paintings. So the blockchain is the tapestry, like the internet is the tapestry. Facebook, YouTube, Google Maps are applications written on top of that tapestry, or art painted on top of that tapestry. Blockchain, the Bitcoin blockchain, is that tapestry, capital B. Bitcoin, the digital currency that you hear about in the media, is an application written on top of the platform, of the tapestry. So that's a painting written on top of the tapestry. So the difference is, the platform, the application written on top of the platform. Now, you have different tapestries. One could be, vinyl, one could be, I'm not an artist, but the different tapestries. And you have different types of paint you can put on it. So one tapestry could be the Bitcoin blockchain, Ethereum blockchain, Dash, etc. Did I come close to answering the question? Just take that as a yes? Okay.
It's very colorful.
Thank you.
So, let me ask, just raise your hand. I don't need to know why, but is there anybody who still questions the difference between Bitcoin and blockchain in the room? Okay, so let me take a stab. Bitcoin is something that can be developed with blockchain. Okay, it's a currency. It's like your coins are developed with silver. I'm in silver, doesn't mean that I produce coins. So I'm in blockchain, it doesn't mean that I produce coins. I can write Wall Street applications, insurance industry applications, and countless other industries. In fact, I frequently say that it's like the internet in 1996 right now with blockchain. There's a very valid business application in every industry right now for blockchain. To say that I do coins, well, that's really just utilizing the general ledger of blockchain. Blockchain is basically a general ledger. Think of it as if everybody in this room had one general ledger on their phone, and it's their bank account, let's say. But you only had a key, an encryption key to see your account. Same ledger exists on everybody's phone. but you only had a key to see your account. We're all in real-time sync. That's the nature of blockchain. As soon as one of us gets hacked, and now you have to imagine there's millions of people in such a Bitcoin, right? An example of Bitcoin. As soon as one person gets hacked, the other 999,999 computers immediately point to that one and say, wait, that one's off. So theoretically, you would have to hack all 1 million computers wherever they are in the world at the same nanosecond to truly disrupt the blockchain. And I challenge, some people do say, well, the blockchain's been hacked. I hear about a bunch of examples or problems with it. It's the peripherals around the blockchain that's been hacked. It's the wallets, it's the reports, it's the deleted code in Ethereum, right? $280 million are locked up. Well, that's going to be brought back because it's on the blockchain. It's the general ledger is still in sync, right? And that's why it's so sound for a general ledger purpose. That's why you're able to confidently, with 100% trust, build out currency with blockchain. So I hope that's a little bit clearer. I don't know, it's a little more of a layman's term maybe.
So the way I usually explain it, I think that different people define blockchain in different ways, and this causes a ton of confusion, specifically when you're reading articles written by people that have different definitions on the term. Some people say that the only real blockchain is Bitcoin, and others say blockchain, not Bitcoin, when they're talking about enterprise applications that could just be distributed databases built on software that's been in development since the 70s. What's most important is to sort of understand the perspective of who's giving you the explanation, who's discussing it, as opposed to kind of having a fixed definition in your mind, because different people are going to give a different perspective on it.
Okay, so let's move along. Here's a question I'd appreciate 3 different views on. Sebastian, we'll start over there with you. Currently to date, there are over 120 hedge funds focusing solely on cryptocurrency and ICUs. Is this a bubble that soon pops? Are we riding a wave that has at least another decade of growth maybe, or more? Or neither? Please explain your perspective.
Sure. So, I find the question a little loaded. I find the idea of calling it a bubble to be interesting, and not the concept of a bubble. Whenever we talk about bubbles, we mean them in a very negative sense, right? But there are 2 sides to a bubble. We have to think about it at all times. Bubbles assist us to travel to a new paradigm. They create railways which go bankrupt, but allow us to create industries that can use those railways, which have been devalued in ways that we never thought. And the internet actually holds very similar promise. And the other side of it is this. I think about what people are doing with cryptocurrencies, and the question I have is the value of the cryptocurrency going to be that it's very expensive and few people own it, but they have made good money on it? Or is the value of cryptocurrency that it's very cheap, but that it drives a whole lot of applications globally? And that's the question I think I actually would ask panelists, I would ask anyone who is in this industry, where do we want to travel? Is $7,000 for a Bitcoin the right price? Is price even what we're aiming for here? Are we looking for distribution? Are we looking for uses? Are we looking to turn it into something? So what's great about this moment right now is that the scenarios at which this plays out in are very significantly there's a wide range of scenarios. And so the question we want to think as investors, as people who are fiduciaries for people's money, is what scenarios do we agree with and what scenarios do we not agree with? And so that's how I want to think about this, not as a bubble that pops. I have my own views, personal views, and some of it is probably FOMO, fear of missing out, that I have about prices. But it's not to me about prices. It's about what structure, what world are we thinking this might evolve into. We can't answer that question completely, but the paradigm shift, if it occurs, will involve a lot of money, and it will probably involve a lot of losers as well. So.
Just quickly, just ask the question one more time. I want to make sure I get it right, because my preconceived notions sometimes take charge.
So we have 120 hedge funds focusing solely on cryptocurrency and ICOs. Is this a bubble? Are we riding a wave that has at least another decade of growth, or neither?
Okay, so when he says this a bubble, I have to take a stab at what this is. My definition of what this is a paradigm shift. You have, over the period of time, say every 50 to 100 to 200 years, a transformational paradigm shift where one technology is obsolesced by another. As time goes on, the distance between these paradigm shifts has been decreasing. Start with the wheel, the invention of fire, electricity, steam engines, gasoline combustion engines. Over the last 40 years, you had micro and mini computers, then you've had the internet. Since the internet, you've had decoding human genome, etc. This compression of time has caused a significant release of value or creation of value, depending on what school you're from. Some people don't believe that it could be created, but this value release is significant. What this is another paradigm shift. But this paradigm shift, I feel, is the most significant of modern time. A lot of people thought it was the internet. There are certain people here, there's a dividing line where those at a certain age remember life before the internet, and those after a certain age can't even imagine life without the internet. Imagine 15 years in the future and nobody's ever heard of living without blockchain technology or DLT. Everything is done through the blockchain. You never need a third party. You never need a trusted party. That's what I see going forward. If that's the case, then no matter what price you're discussing, it is minuscule compared to what comes forward. What the question needs to be asked is what business models are going to be obsolete by this technology versus this is a bubble, because you don't have enough liquidity for price discovery. So discussing whether it's a bubble or not is, a misnomer. It doesn't make sense. By trying to predict which business models will be obsolete, which new business models will come to the forefront, is when you get to decide, what value you need to put on this and what direction everything goes in. In closing, remember, technology has never put a single company out of business, not to my knowledge. Okay, what technology has done, the paradigm shift has done, is it enabled a new business model that obsoletes the previous business model. Margins compress, collapse, go negative, the company goes out of business. Polaroid or Kodak had the patent on the digital camera, but they were still wiped out through margin compression. You're going to see that happen not only in the financial industry, where almost everybody's focusing, but in any industry where you have an exchange of value. And I don't think anybody in this room can think of an industry that does not entail an exchange of value. So blockchain technology allows trustless exchanges of value, something that wasn't capable or possible before.
Can I retort to that?
I guess.
This actually brings me to Cornerstone's, our company's real thinking around this, which is this idea of trust. And we see things like the creation of automated payments, the ability to look at a cryptographically encoded ledger, which says this is all the transactions that have occurred and they locked them in. I think the question of trust is a very important one here. The idea of trustless, for us, feels like the technology creates a free lunch in the sense that we used to have to trust intermediaries to do our transactions, and we will create a world where we don't need intermediaries to do those transactions. Our question is, does it remove the need for trusted intermediaries, or does it transfer trust from one group, who are our intermediaries, who broker for us, who aggregate for us, to gatekeepers, to other entities within the structure? So the question is, does trust change or does trust shift? And our view is that trust is likely to shift, in the sense that if you are stuck outside this system, these gatekeepers will be the decision makers about whether you're able to enter into these markets that are trading tokens or those structures. And so that for us is a little bit of an interesting red flag. We are a little concerned that there's a decision about trustless transactions that don't recognize there's a whole lot of stuff around it. Now, I know there's a lot of applications being developed like that to do some of those elements of gatekeeping, but the emphasis on those gatekeepers become much stronger.
I can't resist. Okay. So he has a point, but here comes the philosophical argument between private networks and public networks. The impetus of having a private network is that you are a gatekeeper. You are the seeker of economic rent. So here you have food, hungry people, and between the food and the hungry people, you have a landlord that owns 1 foot of land. And they charge you $500 to cross his 1 foot of land in order to get to the food. Okay, a typical gatekeeper, economic rent seeker. What a public system does, it connects everybody. So instead of going through this central intermediary, you can go through individuals and circumvent that gatekeeper and access the food. Now that food drops in price because you have more access to it, more economic liquidity. Okay, now it's the gatekeeper's job to take those barriers and then enforce them and increase them. And it's the seekers of economic value's job outside of the gatekeeper to bring those barriers down. So here you have a battle. Okay, our mantra at Veritasium is, of course, distribution. You know, freedom for all who deserve it, meritorious access. Those who already have significant stakes in the gatekeeper system think the opposite. So his point is correct, but it doesn't fully expand upon the philosophical argument.
So, to separate out the question into two parts, is there a hedge fund formation bubble? And sort of speaking as a fund that's currently forming, I don't think so. 90% of startups fail anyways. I don't think it's a statistical anomaly. You'll sort of see this across the startup ecosystem. You'll see this across ICOs as well, although I'd even argue that that might be slightly higher of a failure rate than most traditional startups, but it's all sort of within the same range. It's just a question of marketing. If you're talking about the industry as a whole, I actually agree with both of them. I don't think it's solely about removing a gatekeeper or solely about sort of the trustless environments. I see tokens as sort of running parallel to the concept of a traditional capital structure. You're able to tokenize individual portions of your business model. You're able to sell some sort of excess capacity or access to a network, and it's sort of creating liquidity where conceptually there was none before. If you're looking from purely a market's perspective, this is the first 24/7 global asset class that started at a retail level that is easily accessible with minimal onboarding. And this just has never existed. And in my eyes, that's a market that goes into the trillions, not even, we're barely skimming the surface at 200 billion at this point. And not just that, when you're comparing it to existing asset classes, you're sort of putting a mental block on it, because it's not a proper analogy to say if Bitcoin takes X percent of gold, it'll be at 100,000 or something. There's conceptually no reason that Bitcoin wouldn't be able to go to something like $1 million. There's more factors that go into it, but it's just, you can't use existing paradigms to sort of think about whether or not we're in a bubble. And personally, I don't even think we're scratching the surface. We're still at the early adopter, early innovator portion of the life cycle of innovation.
I agree.
So I'll echo. I pretty much am in agreement with these gentlemen. I do not think that it is a bubble. I think that it is a transition. It's an evolution of trust. Although Sebastian's perspective scares me a little bit and actually makes me want to get more involved before the gatekeepers take over. So let's jump to analyzing potential investments. Okay, so there's gatekeepers, there's evolution of currency, it's barely scratching the surface at 200 million, there's risk to weigh. How does an investor, maybe somebody who has limited knowledge of the actual technology, but is a tried and true investor and wants to get involved, how do they analyze the investment opportunities that are out there in the market? Reggie?
You do it the same way you invest any other opportunity. Investment's an investment. So what you're investing in should not alter your methodology of gauging whether you should invest. Just quickly, we have a couple of hedge funders. Anybody in the hedge fund industry? Asset manager? What's the price of reward?
What's the price I want for Bitcoin?
The price of reward.
Of reward.
Yes. Trick question.
Are you asking risk versus reward?
Yes.
My risk reward analysis?
Right. Just in layman's term.
Just risk.
Just
the
risk
price of
is-
reward?
I think risk is the answer.
Oh,
Question.
it's
Risk.
volatility. Yeah.
Okay, well, volatility. I'm a stickler for this because I see the media misrepresents a lot of things, and especially DLT or blockchain related, and these misrepresentations now become fact simply because they've been repeated over and over. So just to use this term, I believe that the price of reward is risk. So anytime you seek a reward, in order to gauge whether it's a good investment, you have to measure the risk, units of risk you pay to receive that reward. So if I pay $1 of risk, right, to get $5 of reward, then theoretically I'm up 4 units. Very good investment. If I pay $2 of risk to get $1 of reward, and then I overpaid. Now, the way math works, you may see a nominal gain by paying $2 of risk for $1 of reward, but over time, you should lose money. Okay. Now, you spoke on volatility. Most of the units that are invested or bought, the risk is calculated as volatility. And if you look at a lot of the pop media, they say don't invest in Bitcoin because it's volatile. And my response is big deal. It's volatile. It doesn't matter how volatile it is if you don't measure the reward that you get for the volatility, number one. Number two, volatility is not bad, even if you're an investor, not a trader. So I can purchase this iPhone. This iPhone goes up 10% in price, then 30% in price, 8,000% in price, then 40,000% in price. It is volatile as a long-only investor. Do I have a problem with that? Well, I don't personally. I don't know if anybody else does, but I appreciate the volatility shooting through the roof. So as a long-only investor, what you're really concerned with is downside volatility. So it doesn't matter how volatile, it doesn't matter what the standard deviation is. You're concerned about how far it goes against your investment thesis versus how far up. So to simplify that, you measure the potential investment opportunities in cryptocurrencies by risk-adjusted return. You take the downside, and downside should be defined as it going against you. You take the downside risk, you subtract it from your reward or upside return. You have that number, and then you can compare that number to oil, to bonds, to treasuries, to real estate, to going out on a date with your ex-girlfriend, anything. Okay, risk-adjusted return.
Do you want to add to it?
Yeah, definitely. So completely agree. I see the industry as a whole as an option without time decay. So it's not like it's going to zero because of some sort of theta or whatnot. In my eyes, Bitcoin in 20 years is either going to be at 0 or a million, and probability-wise, I see a positive expected return in my eyes. If you're looking at individual projects, I would compare it to sort of a blend of analyses between global macro and venture capital, which would normally have nothing at all in common, but in this case, you sort of have the worst of both worlds. You're supposed to sort of try to understand what are the broad industry fund flows, how are funds flowing between different projects when they're trading, and then you sort of do the traditional analysis of team, project, market size that they're trying to address. And you also look at things based around the type of token that you're trying to analyze. If it's an equity token, it's pretty straightforward. You do discounted cash flow model, figure out what the assets of the company are, relative valuation, whatnot. If you're talking about tokens that represent excess capacity, if this is a limiting factor, you start thinking about the intensity of the token use within the ecosystem. And you think about that the same way if you start looking at the token as a piece of the individual business process as well. So sort of a coupling of a lot of different disciplines, but ultimately you have to bring it back to risk and reward. And you're sort of doing the research to de-risk projects in your mind. So figuring out how competent is the team, have they done this stuff before, what is their impact on the market, how well can they market their product to affect those in fund inflows and things like that. So very, very dynamic way of sort of looking at this, ultimately leading back to Reggie's risk versus reward.
And just one addendum. If you take the two largest cryptocurrencies, which would be Bitcoin and Ethereum, you run a downside only risk-adjusted reward analysis, and you compare it to anything else, it blows every major and almost every minor asset class out of the water, 20,000% or so, easily. And it's not complicated math. You could download a Sortino ratio. You could adjust it for downside risk. You just take a look at the numbers. Bitcoin started in 2009, 2010. I think it was about maybe 2 to 10 tokens per penny, something like and Bitcoin took a pretty big, 20 units per penny to 6,300, and then compare it to any stock, any asset class, oil, commodities, fixed income, you name it. You can even multiply those legacy asset classes by 10. It won't even come close. But if you read the media, they still say it's risky because it's volatile. You have an equation. The equation means you have to analyze both sides, not just one.
Those are two extremely well thought out answers. I like a lot of what both of these guys just said. I want to. I was taking notes, and there's so many points on that. But, you said in your last statement it's a $200 million market right now. Sorry, 200 billion.
Yeah.
Not even scratching the surface at 200 billion.
Yeah.
That's why the risk is just going to be so minuscule, right? In Reggie's statement. I do, however, also want to bring it back to the point that Kirill made was it's either going to be 0 or a million. And yeah,
It's an option.
I actually do believe that. I'm going to disagree with Reggie and think that it's probably going the 0 route unless it's tied to another thing that Kirill also mentioned was the success of a company. So take something like Bitcoin. It's not tied to anything. Now you have all these other cryptocurrencies coming out. This is the reason. So one of the things that we're doing when we issue our ICO in March, our ICO will have a weighted confidence level based on artificial intelligence as well as machine learning and using the blockchain that actually uses the general feel of is this company successful or not. So buying into our currency will actually have a measurable indicator as to whether or not it's increasing or decreasing. And I personally feel that's where the industry's going, which is going to drive the 0 or million factor, one way or the other, based on whether or not currency is tied to anything. So I was just, you guys just hit some really interesting topics there.
Yeah, so it's interesting because you don't necessarily have to think about it as an actual company because a lot of these are just open source projects and teams can build whichever direction they want. I mean, not to open up the rabbit hole, but there's been a lot of discussion about how Bitcoin should grow, and that's sort of sprung into a few multiple projects. So it's sort of important to not just gauge the company, but sort of the community that's involved in this. So is it mostly just people trying to pump a token, or is it people actively involved in the project? So it's another dynamic that you don't really see in traditional asset classes, sort of the investor base itself.
Sebastian, I don't want to leave you out on this topic because do you want to weigh in? I could jump to the next question that actually has your name on it anyway, but would you like to weigh in a stateless digital currency of value?
So I think this comes back to the point I made before, and we at Cornerstone do believe in appropriate skepticism, and the two gentlemen just then, I think, are putting together a powerful endeavor on this process. We do believe, because we like to look at investments through the environmental, social, and governance factors. What are the social trends that catalyze things like this? And I think Reggie has referred to them in the past. There is concern about the quality of our institutions, right? About whether we trust our banks and our central banks to do what we think is right. Reality passes, we've lost a lot of trust, I feel, on an individual basis in the US. The number of people who say they trust most other people is now 20%, which is the lowest it's ever been. And so the question for us about why a trustless system would emerge at this point is also important from a thematic place. And the question of trust is that there is a whole lot of entrepreneurial structure around creating what we see as systems which give people more access, that recognize more potential sort of online democracy, or however it's structured. I think blockchain has captured that zeitgeist in a very powerful way. There are other trends, I think, whether it be low yields on investing in other areas and questions about this sort of security nature of our funds, whether it happen, bank closures in different parts of the world. But the question to me still remains, I want to ground this in something foundational, in terms of a trend. And I feel at this stage that our relationship to each other and our institutions has predicated and grown this market in a pretty powerful way. I don't think it's all of it, but I think it feels like a lot of it. And that means that we're innovating in a way that we haven't before, and so that the outcomes will be very different. So what happens to our verticals, what happens to our sectors, what happens to our business models as a result of this innovation around changing the way we think about trust will have repercussions we don't know yet, and so it opens up a whole lot of possibilities. And so that all sounds very high-minded, and but that's kind of my role on this panel. So
Reggie or Krill, and anything on that subject? I'm gonna leave that alone myself. So there's a couple areas that finance and insurance are sort of staying away from cryptocurrency at this time. One is the credit system. There really isn't lending being done with cryptocurrencies yet. And the other is potentially even more interesting. It's really the institutional side. So the question here that I have written down is, what are those barriers for institutional access to cryptocurrency? Krill, you wanna
Sure.
take that?
So the market is still very inefficient. There are some lending markets, but if you look at the cost of capital on some of these tokens and projects, it goes up to 25 or 50% annualized, which is absolute lunacy if you compare it to traditional assets. Cryptocurrency in general does not play friendly with asset classes. Your vendors don't support it. It needs its own security infrastructure, which becomes one of the most important pieces of your overall operations. Third-party custody is still a question, because if you're trading securities, they need to be custodied by a third-party custodian. And in this space, our fund is avoiding securities because we don't think that there's any qualified third-party custodians. And then you have concentration risk on that custodian as well, which is another issue. So the cybersecurity of it all is functionally, you have to manage the PIN code for your bank account. And you have to make sure that there's no way anyone has access to it, because once someone else does, it's gone. So risk and analytics tools are just starting to get built today. I'm speaking to people that are literally building it from bottom up at this point, because this doesn't show up on your Bloomberg terminal outside of maybe Bitcoin, Ethereum, and whatever tracking ETN is out there in Europe. You need to sort of rethink your entire investment infrastructure to get exposure. Personally, I think that the easiest way today to sort of play in the space, if you want to just buy and hold Bitcoin, there's a few easy ways to do that. If you want broader exposure to sort of alpha generation, then it's as an LP to a fund, like Full Node. But it's generally very hard, and it's something you really have to think through. Everyone's actually watching this space. Two Sigma's watching this space. I think Goldman, there's some news around them possibly launching some sort of market-making desk. I mean, Credit Suisse was holding an investment conference 2 weeks ago. Custody is a massive revenue opportunity for banks. Market-making is a massive opportunity for funds and banks. I think SIG's been in the Bitcoin space for years at this point. A couple of other major prop shops. So it's just a matter of how well these institutions are able to innovate and sort of get from point A to point B, and the sort of roadblocks that management imposes, because this is an incredibly lucrative field from the service provider side in addition to the fund management side, but you just have to be in the position to sort of create and develop that infrastructure, which is sort of ground up.
So do you think that the interlinks for the cryptocurrency and the traditional asset classes are going to be the banks themselves, or are you viewing like an ETF that actually sort of brings them together in an investable type of way?
I think the interlinks go even beyond that. In the future, you're going to have tokens that are backed by deliverable commodities that you could trade against futures. You have public equities, even today in Australia and Canada, that are launching ICOs. Figure out how much they're likely going to raise and how creative that is to a balance sheet. You can run your traditional DCF analysis. it goes into the individual business process of every single company, possibly in the world, if it makes sense for them. So in the future, I see not cryptocurrency not just affecting sort of cryptocurrency companies, but traditional companies, their institutions, and you're sort of going to have to analyze how tokens play a role within that capital structure.
So that's the market is just enormous. There's no question about that. Let's go to Q&A.
Risk analysis and evaluation is the meat and potatoes of what most people do in this group, and that your transactions are completely anonymous for the most part. How can you conceivably say that you know how many transactions actually result in the exchange of tangibles as opposed to cryptocurrency becoming a self-fulfilling prophecy of people trading it for speculative purposes? How much of this actually ends up being a home, a car, land, business, food, something tangible? Do you have any way of measuring that?
Well, I'm gonna give that to Kirill, but I'll point out one thought is that I think the part of the paradigm shift that blockchain is driving is what is really I think it's the transaction that's actually becoming important, and not necessarily the value or who's transacting it. Or if I design a trusted consortium for selling automotive vehicles, as you suggested, and all of a sudden I acquire all of the transactions, what's really the value? I mean, there's more value there than the actual product. That's in my high-level perspective.
So the way I like to look at it, I kind of look at it from a modified quantitative theory of money approach. So you sort of have individual use case, which represent certain transactional demand, and you can divide that by the velocity of money, so how quickly these tokens can be used to achieve those functions and sort of the outstanding tokens in the industry. In real time, you can't, because if you're talking about new wallets, you can have a $200 million movement or $1 billion movement, and it's just an exchange sort of moving around its money for its own operational purposes. So it's tough in real time, but you can plug in your own sort of assumptions of industry growth, and there's a few other ways of doing it. Some people look at Metcalfe's law, which is around network effect and the number of network participants, sort of measuring a correlation between that and future price as well. There's a few different ways people are looking at it.
Hi, I have a question. First, could you just tell us a basic concept of Bitcoin? Because to me, Bitcoin is just something that is common for all the currencies. And if you could just give us a basic understanding of that, that's number one. Number two is you also mentioned artificial intelligence. And I think that this is something that has an incredible growth potential, artificial intelligence, but how do you connect the two?
I'll take the second one if someone else wants to take the first.
I'll do the first one. Okay, remember, the Bitcoin is an application built upon a framework. The framework, the infrastructure, is the blockchain, the Bitcoin blockchain, the application, which is, in this case, a digital currency, and there are many. This is just one,
Okay.
right? Okay, this application is a digital currency application. Think of it as an account of value. There's a ledger. You have one Bitcoin. I send one Bitcoin to him. It goes through the blockchain. There's a permanent record of it that everybody can see. The assertion that Bitcoin, these digital currencies, at least Bitcoin, is anonymous is not true. That's something that was fostered by the media. It's pseudonymous. It's attached to a 26-character alphanumeric string. And it's attached to that, so everybody can see it if they look at the transaction. Now, that's all it is. It's a unit of account that serves as a currency, but unlike fiat currencies, which are called dumb currencies, this is a smart currency. This currency has its own transportation rails, called the blockchain. Okay, these transportation rails don't obey geopolitical boundaries. They could go over water, over land, through Russia, through China, etc. They don't obey socio-political norms, socio-economic stratification. So it's sort of a magical currency. It's also a currency that heretofore has a transportation rail that has never been compromised. Compare this to fiat currencies. The fiat currencies are compromised regularly. Your wallet, and everybody here has a digital wallet, it's called a bank account, okay? That wallet, the custodian of that wallet is usually compromised regularly. I think Jamie Dimon said that JP Morgan gets over 100,000 hack attempts per day. There's no telling how many times it was succeeded, but you know, if you follow the, forgot the name of it, there was one hacking with the social engineering malware, and they've stole billions of dollars. The central bank, the New York Federal Reserve, was hacked through its member banks. Almost every major financial institution has been hacked, except for Bitcoin. So, without going into the valuation argument, these are some of the characteristics that make it different and special. And it's programmable, so you could do additional things with it. And that's one of several other products and several of the trades. But in short, it's a digital currency application, an account of value that has its own transportation rails, that doesn't have to adhere to any of the legacy norms that affect fiat. Its governing agency is math. So as long as 2 + 2 = 4, this transaction should work. Fiat is backed by the full faith and efforts of the US government for the US dollar, or GMD for Jamaica, the yen, etc. Those rise and fall, and if you look at any fiat currency over time, by default, it loses its value. If you compare Bitcoin in 2009, the US dollar, which is the reserve currency of the world in 2009, go up to 2017, the US dollar has lost X%, the euro, pound, etc. Bitcoin has went from 0.02, about 2 Bitcoins per penny to 6,000 and change. That's because of the deflationary nature of the application. Did I answer your question?
Yeah,
And to the second part,
yeah, artificial intelligence.
Artificial
and what it
intelligence.
has influence on it.
blockchain, and I even like to put machine learning in there. They're 3 entirely separate technologies. They're separate. It's the engine of a car, the wheels of the car, and the frame of the car. They're 3 entirely separate things. But they enable each other. So in useful applications, they don't have to, but for instance, on Wall Street, they're very much so supply chain going to enable each other. Let's take, when should I buy in supply chain? Let's say there's a big bank, global bank, any entity, large organization, doesn't even have to be a bank, but you know, it's best for me. So you might have an artificial intelligence program spit out, the cost of pencils is going to go up. Buy them now. Okay? That might be your artificial intelligence telling you that because it's analyzing market conditions. Now, that's great, but if you truly want to automate, you need to be able to execute a financial transaction to actually buy the pencils.
Right.
Currently, in artificial intelligence, that doesn't happen. But it does happen on the blockchain. So the artificial intelligence will send a buy signal to another program that's built on blockchain that does have the financial regulatory strength within that organization to execute the transaction and be able to complete that automated process.
Makes sense, thank you.
So quick question. So do you guys believe that the potential introduction of the futures market for Bitcoin would be a good thing or a bad thing? Do you think it could impact the Sortino ratio? Because now you have the option to short the currency. Or do you guys have any thoughts on that?
So I don't know the specifics of the actual futures product, whether it's cash deliverable or deliverable in the underlying Bitcoin, but it just serves to further legitimize the industry, and it's just a representation of industry growth.
I believe it's a cash deliverable, but you have the ability to short Bitcoin for years, simply by using margin accounts, or you could use swaps and derivatives. The early implementation of our product was a peer-to-peer digital swap system. You could go to any Bitcoin, not any, but most of the second-tier Bitcoin exchanges, they have the ability to short Bitcoin. It legitimizes Bitcoin, okay, and it should drive the price of Bitcoin up because it drives more institutional players into Bitcoin. Bitcoin right now is a very, very small market, very, very small, okay. He said it was a $200 billion opportunity now. There are asset managers that control multiples of $200 million. So you're talking not even one BlackRock. Okay, think about the entire world. Now, if you think about that type of liquidity going into Bitcoin, sky's the limit. But Bitcoin is also a manifestation of the media. Bitcoin is like Internet 1.0. Now we have platforms, we have tokens, you have blockchains that have are significantly superior to Bitcoin in almost every way except for media exposure. As time goes on and the business models are fully achieved by these entities or not, or more people recognize what they can do, such as Dash, such as Ethereum, such as Veritasium, the guy with that handsome CEO. That was a joke? Okay. As more people realize what's available, then more economic value will flood into these markets, and you'll see a general rise in prices. Of course, you will also see failures because, as you know, the other guest said, I think the failure rate should be about norm. About 92% of most startups fail. You have a middling of about 6%. But in terms of private equity and venture capital, the real meat and potatoes comes from that 0.9%. And that 0.9% are home runs. Those would be the Googles and the Facebooks. That should be multiplied by a significant factor because the blockchain technology enables significant liquidity or lack of friction. So when you remove the barrier, the friction barrier, the gatekeepers, you enable significant value that wasn't possible before. Now that 11-year-old mathematical genius in Sri Lanka, who was always locked out of the markets, but always knew the price of the agriculture commodities, can trade directly with the PhD Penn graduate at Goldman. Okay, something that wasn't capable before. And that's just the tip of the iceberg. New business models, new value creation, new winners, even more losers. But the losers are like the phoenix, burns, crashes, reborn from the ashes.
So just in the interest of time, I think we have time for one more question, which I think the mic was given out over there. So.
Sure. So a couple of questions. What's your view about the ICO tokenization? What happens to those startups 5 years from now? And the other question is for the cryptocurrency hedge fund, what are the risks that keeps you awake at night? Can you share with us, and how do you manage those risks?
Sure. What was the first question? ICOs. 90+% of companies fail. So will ICOs, probably to a greater extent, just because barrier to entry is probably arguably lower. What keeps me up at night? You guys can all probably see how much hair I have left. So security keeps me up, volatility keeps me up, broad market changes keep me up. I mean, even in the last couple of days, to anybody that's actually actively following this space, you probably got very little sleep. It's something you get acclimated to over time. I personally do not know how I can ever trade equities again. Out of money options are probably less volatile than this industry for now because it's so early on. We're still at an early innovator stage. So volatility, security, and finding interesting investment opportunities. That's, I guess, my top three.
Great. Well, thank you so much. We just probably scraped the surface, but that was great. So want to thank all our moderator, our panelists, and hopefully they'll hang around for a little bit so people have questions. Bring them a glass of wine or something like that to help bring it out. But so on behalf of the roundtable, I want to thank everybody for coming out this evening, and I encourage everyone to stay. We're going to have a network reception after with the bar open and flowing. So on behalf of the New York Alternative Investment Roundtable, just want to tell people about membership for those who are guests in the room. We are an organization committed to promoting best practices in education in the alternative investment community. And so if you are not a member, you can apply on our website or ask someone with the management committee designation on their tag. And then lastly, just on upcoming events, the next roundtable is going to take place on December 13th. It's entitled The Strategist's View of 2018 and Beyond. We will be featuring Joe Lavornia, who's a chief economist, and the monthly call coming up is on compensation structures and their implications for alternative asset managers, which is taking place on November 20th at noon. That's obviously a topic towards the end of the year that's something people are very focused on. And I guess one more lastly is that we are, if anyone is interested, the 2018 Sustainability Investment Leadership Conference is on May 2nd And for all members of the roundtable, if you sign up before December 31st, you get a very discounted rate of $100. There's more information. There's a code we can give you if you're interested. So I want to thank everyone for coming. Thanks again to our panel and to